something. Have you ever noticed how something happening 1,000 kilometers away suddenly makes life more expensive in South Africa? Petrol goes up, fuel prices increase, transport becomes more expensive. And suddenly the cost of living feels higher. So many people ask the same question. What does a conflict in the Middle East have to do with my grocery bill in South Africa? Right now, tensions between Iran, Israel, and the United States have escalated. And while this may seem like a distant geopolitical issue, the reality is that the global economy is deeply interconnected. Events happening on the other side of the world can ripple through oil markets, global trade routes, currencies, and supply chains, and eventually they reach our daily lives at home. Today, I want to break this down in very simple terms. We're going to talk about what is actually happening globally, why the Middle East matters to the global economy, why conflicts like this affect petrol prices, why food prices often rise as a result, how it affects inflation and interest rates, and what this means for the Rand and the South African economy. Most importantly, we will be discussing what individuals and businesses can do during a period of global uncertainty. Hi everybody, I am Humairaa from HM Accounting, and on this channel we're going to be talking about economics, business strategy, and financial intelligence. So let's unpack this together. Now, to understand the impact, we need to first understand why the Middle East plays such an important role in the global economy. This region is one of the largest oil producing regions in the world, and oil is still one of the most important resources in the global economy. Almost everything we consume depends on energy somewhere in the supply chain, whether it is food production, manufacturing, transport, shipping, even packaging. So energy is embedded in nearly every product that we use. But there is another crucial reason why the Middle East matters. There is a narrow shipping route called the Strait of Hormuz. It is between Iran and Oman, and roughly 20% of the world's oil supply passes through that single passage. So that means about 1 in every 5 barrels of oil traded globally travels through that route. So whenever tensions escalate in that region, the markets become extremely nervous. And because of oil supply being disrupted, even temporarily, global oil prices can move very quickly. And that's exactly what we've already seen. Oil prices have surged about $90 per barrel, and analysts warn that this could climb even higher if the conflict escalates further. Now, why does this affect South Africa? Right? And this is where South Africa enters the picture. South Africa does not produce enough oil locally to meet its needs. We import most of our crude oil and fuel products. That means our economy is highly exposed to global energy prices. So when oil prices increase globally, South Africa pays more, and that increase flows through the entire economy. The chain reaction usually looks like this. Global conflict means oil prices rise, fuel becomes more expensive in South Africa, transport costs increase, businesses face higher operating costs, and then consumers eventually pay that price, pay higher prices, right? So this is one of the main ways that geopolitical events affect everyday life. Now, the first place that most South Africans feel this impact is at the fuel pump. South Africa's fuel pricing system is linked to 2 key factors. One is the international oil prices, and 2 is the exchange rate. So when oil prices spike globally, it affects the basic fuel price, which feeds into the price of petrol and diesel locally. But fuel doesn't just affect motorists. Fuel is embedded in the cost structure of almost every industry. Truck companies rely on diesel. Farmers rely on fuel for tractors and irrigation systems. Retailers rely on transport to move goods across the country. And so when fuel prices increase, businesses face higher costs, and eventually those costs are passed on to consumers. Now, one of the biggest and often overlooked impacts of rising energy prices is food inflation. Food production is actually incredibly energy intensive. let's just think about the journey that food takes before it reaches your plate. Farmers need machinery to plant and harvest crops. That machinery runs on fuel. Then fertilizers are used to improve crop yields. Now, many fertilizers are produced using natural gas and other energy-intensive processes. Then the food needs to be transported to processing facilities, then to distribution centers, and then finally to supermarkets. Now, each step requires transportation, refrigeration, and packaging, all of which rely heavily on energy. So when oil prices increase, the cost of producing and transporting foods also increase. And those higher costs eventually show up in prices that the consumers pay at the grocery store. That is why global energy shocks often lead to food inflation. And unfortunately, food inflation tends to hit every consumer and it hits lower income households the hardest. Now, rising energy and food prices feed directly into inflation. Inflation simply means that the general increase in prices rise across the country, right? And inflation is one of the biggest economic challenges that many countries are currently facing. When inflation rises, central banks, including the South African Reserve Bank, often respond by keeping interest rates higher. And higher interest rates are meant to slow down spending and to control inflation. But they also make borrowing more expensive, which means that home loans become more expensive, business loans become more expensive, consumer spending slows down, and economic growth can also slow down. So global conflicts can indirectly influence interest rates and economic growth here at home. Now, there's another factor that often amplifies these effects, which is the exchange rate, and I briefly mentioned it earlier. But during periods of global uncertainty, investors tend to move money into what is considered safer assets, particularly the US dollar. When that happens, then emerging market currencies like the South African rand often weakens. And when the rand weakens, imports become more expensive. Now, South Africa imports many essential goods, believe it or not, things like fuel, machinery, technology, industrial inputs. So when the rand weakens while global prices are rising, that impact can be amplified. And in some cases, we experience a double pressure because higher global prices and then a weaker currency. Now, another issue that people don't always think about is global supply chains. And if tensions escalate in regions that control major shipping routes, then global trade can slow down. Ships may need to take longer routes. Insurance costs for shipping can increase. Transport costs rise and deliveries take longer. Businesses that rely on those imports may face higher costs, delays, cash flow problems. And we saw something similar during the pandemic when supply chains were disrupted. So geopolitical conflicts can create similar effects to that. Now, situations like this highlight a very important reality, is that the global economy is extremely interconnected. A geopolitical event in one region can ripple across the entire world. Energy markets react, financial markets react, currencies change, trade routes shift, and eventually households and businesses feel that impact. For emerging economies like South Africa, these shocks can be particularly challenging, which is why economic awareness and financial resilience is so important. Now, the important question becomes, what can we actually do about it? Because we obviously cannot control global geopolitics. But what we can control is how financially resilient we are when global shocks happen. And there are a few practical things that individuals should be thinking about in periods like this. The first is financial buffers. Economic uncertainty tends to expose households that are already financially stretched. When fuel prices rise, food prices rise, and interest rates remain high, even small changes in expenses can create pressure. And that is why having an emergency fund is so important. Ideally, households should aim to have 3 to 6 months of essential expenses saved if possible. And I know that this isn't always easy in the current economic climate, but even gradually building that buffer can make a very significant difference. The second area is debt management. When inflation rises, central banks often keep interest rates higher for longer, which means debt becomes more expensive. Now, if you have variable interest debt like credit cards or certain loans, the cost of servicing that debt can quickly increase. So periods of global uncertainty are often a good time to review your debt position and start asking yourself questions like, are there high interest debts that you can reduce? Are there expenses that you can restructure? And can you improve your monthly cash flow? The third area is energy and transport efficiency. Now, this might sound simple, but energy costs ripple through household budgets. Being more mindful about fuel consumption, transport planning, or electricity usage can reduce some of that pressure when prices increase. And the fourth point, and this is something I talk about often, is income diversification. Many people rely on a single source of income. But economic volatility reminds us that diversification matters. That could mean building a side business, investing in skills that increase earning potential, or developing additional income streams over time. Financial resilience today is not just about saving money, but it is about creating flexibility in how you earn and how you manage that money. For business owners, the conversation becomes a lot more strategic. Periods of geopolitical uncertainty require businesses to be more financially disciplined and forward-thinking. The first area that businesses should focus on is cost visibility. So many companies don't actually have a clear breakdown of how sensitive their business is to rising input costs. So if your price increases, what does that do to your margins? If transport costs rise, how does that affect your pricing? Understanding your cost structure allows you to make better strategic decisions. Now, the second area is cash flow management. During uncertain economic periods, cash flow becomes even more important than profit. Businesses should regularly review their cash conversion cycle, their payment terms, their inventory levels, and their liquidity buffers. Because businesses that manage cash flow well tend to survive these economic shocks much better. The third area is supply chain resilience. So if your business relies heavily on imported goods or materials, geopolitical disruptions can affect both cost as well as availability. So some businesses are beginning to think more strategically about supplier diversification. In other words, not relying on a single supply chain or geographic area. Now, the fourth area is pricing strategy. So when costs increase, businesses often struggle with whether or not to increase prices. But pricing is not just about reacting to cost increases. It's about understanding value. So businesses should be asking, can we improve efficiency instead of increasing prices immediately? Can we adapt packaging or service offerings? Can we reposition our value proposition? And the fifth area is energy efficiency and operational optimization. Now, energy costs are becoming increasingly important form of business operations. Businesses that invest in energy efficiency, technology, and operational improvements often gain a competitive advantage over time. And finally, one of the most important things that businesses can do is called scenario planning. So instead of reacting when these costs increase, smart businesses ask, what happens if the fuel price increases by 20%? What happens if the rand weakens significantly? What happens if supply chains slow down? Now, thinking through these scenarios in advance allow businesses to respond much more effectively when disruptions happen. So while global conflicts may feel outside our control, financial awareness and strategic planning can make a significant difference. For individuals, it's about building resilience. And for businesses, it's about building adaptability. And the organizations that tend to navigate economic volatility best are the ones that prepare before these shocks happen. So the conflict between Iran, Israel, and the United States may feel geographically distant, right? But in a globalized economy, distance does not necessarily protect us from economic consequences. Through fuel prices, food inflation, currency movements, and global trade, events in one part of the world can affect everyday life somewhere else. And understanding these connections help us to make better financial and strategic decisions, because today economic awareness is a form of financial intelligence. Now, I would love to hear your thoughts. Do you think that global conflicts like this will continue to push up the cost of living in South Africa? Let me know your comments in the comment section below. And if you found this breakdown helpful, please do like, share, and subscribe for more discussions on economics, business strategy, and financial intelligence. Thank you so much for watching. I will see you in the next video.